Okay, good morning then. Hope you all had a nice bank holiday weekend. Here we are, 8th of May, and pushing ahead. Definitely an interesting week, I would say. Thursday's going to be particularly interesting. We've got the Bank of England. We've also got some US inflation data. So I think Thursday is probably, well, most likely going to be the most interesting day of the week. However, tonight we do have Donald Trump making some announcements around the Iranian deal, or I should say sanctions. Let me transition my screenshot. If you've been reading the FT this morning, then a lot of attention in and around this, and certainly a lot of attention around this story yesterday as Trump was firing off, in his typical style, firing off a few tweets around this topic. And via Twitter, he has announced that he will be making a decision, or he'll be announcing his decision on the Iranian deal. That's the nuclear deal. He'll be making his decision, and he'll be announcing it at 2 p.m. US time. So that'll be 7 p.m. London time tonight. And this is whether he's going to pull out of this agreement that was made. And given that Trump in the past has called this agreement crazy and ridiculous, you know, there's certainly risk that he's going to pull out of this deal, and that will most likely, if he does pull out, this will see perhaps sanctions being implemented on Iran again, which could, it's hard to judge at this point, but we might be looking at something like 300 barrels of oil per day coming off the market due to new sanctions being implemented. If you have a look at, let's have a look at the oil chart straight away, because this was probably the most interesting mover from yesterday. Of course, most markets open yesterday globally. In the UK here, we had a bank holiday. But as you can see, WTI crude just into the kind of European close last night, $70.84, marking a new 4-year high. We then had a little bit of a correction back lower into the US close. But as you can see, we kind of stabilized that, and we're just tracking around $70 so far today. Quite tight in the range so far, but certainly the trajectory higher in recent weeks, and it's been a very nice pronounced upward trend. You know, this has been off, well, I mean, let's go to a daily chart, because obviously oil's had a good year. It's not just the last week or so. If you go back to the start, well, let's say the end of December, and if I mark up a key line on this chart, which was February's low down at $58, if you go from that Feb low, then, you know, three and a bit months here, we've gone from 58 bucks to 70. That's a huge move. And of course, more importantly, I know we've been talking about this a lot, but always worth reminding ourselves. If we go, actually, I'm going to go to a monthly chart, because to go back to 2014, that was the last time we were trading at 70 bucks for WTI crude. And when you're looking on this time period, then, you know, it's a pretty remarkable recovery in the last 2 years, considering we were down at 26 bucks, crashing down to $26 at the start of 2016. So we've come a huge distance, and particularly end of last year, start of this year. A lot of this is, well, it's both supply and demand side, of course. The upside, the demand side is very positive, given that we've seen the best global GDP growth for 10 years. In the last 6 months, we've seen the best global growth for 10 years. So clearly, from a demand point of view, that's been very positive. We've had now a couple of years worth almost of OPEC and Russia production cuts, I should say 18 months actually. And so slowly this has reduced the oversupply, the oil glut that led to the collapse in prices, of course, earlier on. Now, into the end of last year, we had dollar weakness, which also helped with this upside. But of course, that's flipped now. We've had a pretty pronounced period of dollar strength in recent weeks. But actually, it's the perhaps supply risk that's come back in that's offset the dollar strength, because dollar strength would be a negative for oil prices. But the supply risk from perhaps the US backing out of the Iranian nuclear deal, so that could lead to a drop of 300,000 barrels a day. We've also seen, well, the likes of Venezuela, they're producing about 600,000 barrels a day less than they were doing 6 months ago. And of course, you've got general unrest and risk within the Middle East, you know, with regards to the ongoing Syrian situation, obviously destabilizing the region. That's been the case for years, of course. But so you've got a little bit of supply risk now, specifically off this Iranian deal. Now, so 7 p.m. tonight, Trump's going to make his decision. Will he back out of this deal? If he does, then this should lead to the price of oil continuing to push higher. Now, how high? You've got to go back to long-term charts to obviously look at where we've been trading in years gone by, and I would say $75 is a huge level. That was the 2011 low. We almost got there in 2012, but not quite. But I would say clearly above 70 bucks, it's $75, so $74.95 being exact, being the October 2011 low. So $75 is the target. If, I'm not saying, you know, we're not going to spike there immediately off Trump's decision to back out of the nuclear deal, but I would say that's a target in the weeks to come if they back out. Now, of course, Trump might turn around and surprise us and actually not back out of the deal, in which case actually you're probably going to expect some downside for crude, especially as the dollar remains strong. Okay, so certainly for today, I would say all eyes on oil. And of course, oil plays a role in terms of, you know, you're starting to get up at 70 bucks. You're starting to get some concerns over, you know, the headwinds that this potentially provides for US growth as energy costs get more and more expensive. Obviously that's good news for all producers, but obviously everyone else it's not good news. And then it's the inflation side of things that we need to be conscious of. And as we move closer to June, where we're expecting the Fed to hike rates again, of course this upside on crude is certainly helping on that sort of uptrend on the inflation side, which is pushing the Fed towards thinking that they may have to hike faster. So it's all kind of tied in, but certainly crude oil, definitely an important market this week. And certainly at 7 p.m. tonight, keep your eyes on Twitter. Keep your eye, well, it'll be televised live, I imagine. This will be Trump from the White House making his decision. But for now, $70 seems to be the consolidation point, and really hard to judge where we might go from here until that announcement tonight. I'd keep it quite tight unless Trump gets out on Twitter. Look for around about 10:45 to 11 a.m. London time as being a favoured sort of time period for Trump to tweet. This is when he's rolling out of bed in Washington. So keep your eyes on Twitter around that time. But otherwise, we're waiting till tonight. Okay, so that's certainly one of the big events, certainly the biggest event of the day, I would suggest. Let's have a look at the day just in terms of the calendar, and then we'll look at some other things that are happening this week, and we'll look at some of these other markets on the charts. So here's the calendar for today, Tuesday the 8th of May. Now, basically, I'm here to report that there's nothing on this calendar that looks of any interest whatsoever. We've had some German data earlier on this morning, but that's all come and gone now. And really, API crude inventory data at 9:30 p.m. tonight may well be the most interesting, but of course for crude oil it's definitely going to be more about Trump's decision at 7 p.m. rather than the API data. So if we look down further though, we do have Fed's Powell was supposed to be talking. Let me just get my news feed going. So keep your ears peeled for any comments from Powell. I'm just going to check. I mean, he has said that the market is reasonably well aligned with the Fed dot plot, and adds markets should not be surprised with the Fed's actions. And that's been certainly something of interest in recent weeks, I would say, and that is markets moving back more into line with the Fed's dot plot matrix, pricing in more hikes. I think the markets have been guilty of not pricing in a steep enough interest rate curve in the United States, and I think we have seen that. And I think Powell's comment like that definitely, of course, I guess for the Fed, there's not too much surprise ahead. They're going to hike rates in June. Then it just comes down to, are they going to hike rates in September? And if they do, well then are they going to hike rates in December? And we roll on quarter by quarter. At the moment, people are moving towards the idea of 4 hikes rather than 3. And of course, this is something that's helped to elevate the dollar in recent weeks, as we've seen European growth momentum just curtailed a little bit. We're now seeing and expecting the Fed to hike faster, just as we're expecting the ECB to perhaps extend their QE program, albeit at a slower rate, into the end of 2018. So a slight hawkish tilt for the Fed and a slight dovish tilt for the ECB has helped with this dollar movement. But so Powell's spoken already. We've got some auctions, and we've got a 3-year auction in the US later on this afternoon. But look, generally speaking, and as you can see at the bottom of my calendar here, we've still got earnings season happening. Most of the earnings are now done and dusted, though. So from a calendar point of view, today is fairly uneventful. Let me look at the charts, though, now that I've mentioned earnings season. And let's check in on equities on a daily basis. So here we've got the S&P 500. Now let me just tidy this up actually and get rid of that. I'm going to add another trend. We've been in some kind of sort of pennant situation in recent weeks, months, and that's where we've seen this triangle consolidation after the collapse we had at the start of February. We're kind of bang in the middle of that right now. We're pretty much, roughly speaking, in the middle of this this range that was set from the all-time high back at the end of January to the low of the year that was set at the start of February. I mean, this is a monster range, of course, a 10% sell-off in February. So we've kind of been consolidating ever since. Look at this 200-day moving average in here, which has just about supported markets. We've had some very substantial tests of this, certainly start of April and then again middle of last week. And for now, despite some periods of time below this line, each time in the end the market's been able to bounce. What happened yesterday was we found resistance at last week's high, so that's up at 26.82. And just consolidating, virtually no action so far today. But you know, we've been through earnings season, and it's been a funny one, really. I mean, earnings have generally been very positive in terms of looking at the profits and revenues from these companies. But I was reading, perhaps a case in point was Caterpillar's earnings, which were phenomenally strong, really positive. Caterpillar, a company that benefits from global GDP growth acceleration, and we've certainly seen that in the last 6 to 12 months, and so Capital's revenues and profits strongly better than expected. But on the conference call with investors, the CFO was a bit more cautious about going forwards, and he said that most likely he thinks that Q1 would be the best quarter of this year. So, of course, investors kind of panic a little bit about that, because ultimately stocks have been rallying for 10 years, and how much more upside is possible? And when you get comments like that, well, the best period of 2018 is already behind us. Well, of course, this is not what investors want to hear, because investors are trading very much looking forwards rather than back. So actually, Caterpillar's share price dropped 6%, despite stellar numbers. It was the caution on the quarters ahead that investors are most interested in. So even though on the face of it, the numbers have been really strong from Wall Street for Q1, it's that guidance going forwards that has just kept things in check. And so currently we've got some dollar strength, which is a bit of a headwind for US equities. We've got the Fed wanting to be more hawkish as a result of inflation continuing to push higher. Although, having said that, of course, at the end of last week, we had a little bit of a reprieve on the inflation panic, and this was because of the labour market report from the US on Friday. Let's just check non-farm payrolls first. Came in 164,000. This is fine. We're not too bothered about job creation at this point. This information has become less and less interesting. Of course, we're way more concerned about inflation and Fed hikes. And so this is where the average hourly earnings is the more important data. And this disappointed a touch. This is for the month of April, of course, and wage growth up 0.1%, which was slower than expected. Also, they revised down the previous month. And so this kind of just kept things in check. Equities rallied off the back of this in the end on Friday. And so that's the reason why we've been able to just launch and bounce again off this 200-day moving average. But certainly a series of lower highs here. But you would say at the same time, higher lows. This is why we kind of got this pennant formation. And I think roughly this 200-day moving average is pivotal in terms of propping things up on the bottom side. But, you know, let's say Trump announces that the US are withdrawing from the Iranian nuclear deal, and let's say that the price of crude oil spikes and continues to push higher in the weeks to come. Let's also say the dollar continues to stay strong, then actually this could be, and as we move towards that Fed rate hike in June, you know, it may be that tips the balance, and actually we see this 200-day moving average breaking, and we see the S&P pushing back below 2,600, or maybe pushing down to test that February low from earlier in the year. So I'd say for me in the medium term, whilst we have been sideways for months, I still have a slight negative bias, and I'd still expect to see the lower of the year tested first, next, rather than the higher of the year tested. That's my opinion as we move kind of into the middle part of quarter two. Okay, let's talk about the dollar, and actually whilst we're doing that, let's talk about the pound, and let's talk about the most important event of the week, certainly for UK assets, and obviously this is the Bank of England rate hike or not that's coming in Thursday. Just one sec. Sorry, just transition my screenshot. Thanks, Safe. So here's cable. And let's look on a longer time period, because this has been a phenomenal story. Definitely, I gave this, if you were listening to me on was it Friday, I gave this the market of the week. And indeed, you could really say the market of the last sort of 2-3 weeks, because the distance this has tracked through has been quite phenomenal, as we've had yet again worse than expected US economic data. So we had GDP disappointing, slowest growth since 2012. We've had inflation dropping at a faster rate than we thought was going to happen. We've had Mark Carney being dovish. We've then had manufacturing and services PMI data that slightly disappointed last week. And of course, this is pushing into Thursday's monetary policy decision. And if you go back 1 month, it was about 90% chance the Bank of England would hike rates. And now if you check the probabilities, it's less than 30%. So obviously the pound has come crashing down just right at the moment the dollar's been really strong. And so cable's tracked through huge distances here. I'd continue to stay bearish myself. I know we've come a long way already, but I do think there is scope for further downside. We've got few red circles on this chart from Ant's previous chats on this topic, but you know, I'd say down around 135 is where we currently are. If you look at the trend line, if that goes back to kind of 2017, then you know we definitely took this out in style last week. Last week we crashed down through this, and that's obviously technically bearish. I'd say the high point that we had in September 2017 is very important. That got taken out as well. So technically this is certainly very bearish, this picture, of course. And I'd say fundamentally, obviously it depends if the Bank of England hike or not. And there's still enough of a probability that they will to make Thursday's event really interesting. You're going to get big movement no matter what happens. I think if they, you know, it's not only do they hike or not, of course, it's also their guidance going forwards. And the school of thought was, if you go back a couple of months, that the Bank of England had one more opportunity to hike rates before then the summer kicks in with Brexit risk, as Europe and Britain try and you know, figure out the trade agreement. Of course, October 2018 is the kind of rough deadline for getting that trade agreement done, and there's fears that through the summer you're going to have negotiations that are back and forth, and we're going to get risk, and that the Bank of England perhaps wouldn't be able to raise rates during that period of uncertainty. And so the idea was they would hike once in May and then settle down, hunker down for this negotiation period. But what I would say is actually, I don't think they're going to hike. And more importantly, in the meantime, if I show you this chart, you know, the only reason to hike is because of inflation. And not only has inflation dropped quite sharply, and we expect it to continue to drop, but also actually you've seen wage growth tick up, and actually wage growth is now higher than inflation for the first time for a couple of years. And so if inflation continues to drop, and that is an if, but I would suggest it probably will, and that's because the value of the pound is now a hell of a lot. Even though we've dropped sharply in recent weeks, the value of the pound is still way higher than it was 12 months ago, and so that should feed through negatively to inflation. So we expect inflation to trend back towards 2% naturally. So I would say the Bank of England are not going to hike, and I'd say they're not going to hike this year, would be my opinion. Back to the chart. So Bank of England, definitely key event. This is on Thursday. At the same time, we will be seeing the inflation print from the US for the month of April. So that's really important, February's data. Let's check in on euro dollar here. Obviously, the US dollar's been having a great run of it. So we've had a downward trending euro dollar market. So far today, we've traded within yesterday's range, kind of flirting with that low point that we had back on Friday. The kind of payrolls volatility on Friday in the end turned out to be neutral. We kind of closed back where we started, but that low point down around 119.40 and yesterday's low slightly below that. So if I go to a daily chart, of course, this does continue the theme of a very strong downward trending euro dollar, lowest levels since the end of 2017. And what's happening, keep your eye on the emerging market space, because as the dollar strengthens and continues to strengthen, this is really hampering emerging markets. And one of the other key articles in the FT this morning was about emerging markets and how they're under pressure because of a strong dollar. They're also under pressure, and let me explain that. Let me show you T-notes, because of course one of the big stories last week was T-note yields hit 3%. If I go to a daily chart, we hit 3% for the first time in months or years even. And this means that US yields are moving higher, and it's the same at the front end of the curve as well. And this makes the carry trade less attractive. Now, what I mean by that? Well, one key kind of trade in recent years has been borrowing in US dollars, where rates are really low. So you're borrowing at really cheap rates. Then you take these US dollars and you convert them, I don't know, let's say to Turkish lira, and you buy Turkish corporate bonds that are yielding at a much higher rate, let's just say 6-7%. So you're borrowing in dollars at 2 to 3%. You then sell dollars, buy lira, to then purchase Turkish corporate bonds at 7%. So you're borrowing at 2, lending at 7, and this is where you make your money. But of course, now that US yields are rising, this trade's getting less interesting. So when people start reversing this trade, well, they sell their, and one reason they don't like it so much anymore is because as the dollar strengthens, well, a lot of these Turkish companies have borrowed in dollars. And so as the dollar strengthens, for them, the Turkish companies generating revenue in lira, their lira debt costs are ramping higher. And of course, this increases the risk. So investors now sell their corporate Turkish bonds, and they take the lira from that trade, sell lira, and convert it back to the dollar. So this is selling lira, okay? And so you're getting a lot of pressure on emerging market currencies, and it's not just the lira, it's also the rand, it's also the Indian rupee, and actually particularly it's the Argentinian peso, which is getting killed at the moment. And when we talk about, I mean, I've got an interesting chart for you here. When we talk about, are the Bank of England going to hike rates by 0.25%? Are they going to do it or not? Spare a thought for Argentina, who last week had their interest rates, here's the chart, had their interest rates increased from 25% to 40%. Or sorry, it's 27.5% to 40% in 1 week. And here we are panicking and freaking out about 0.25%. This is a crisis. Okay, and this is the central bank trying to stabilize the currency values collapse and emergency status. And so, and of course, but let me go to a 5-year chart, because if you think 40% is high, well, this does take us above the 2016 top for Argentinian interest rates. But go to 10 years, we did get above, oh sorry, hang on, I wanted to go a bit more. Go back to the 80s. Yeah, here we go. Back in the 1980s, in 1990 crisis, look at that, 1,400%. So they've obviously got a long way to go to break any records here. But my point is, keep your eye on, if the dollar continues to strengthen, if US yields do continue to rise, and they will if inflation continues to push higher, if the Fed continue to hike rates, then this dollar strength, this US yield upside, it's going to have more of an effect on the emerging market space. And some countries are more vulnerable than others, and particularly Argentina, particularly Turkey, South Africa. And so this might turn into a much bigger story as we go through the summer. Right, I think I've probably gone on long enough here. Let's get knuckled down for the session. Things are quite quiet and subdued, I would say. Don't look for too much dramatic action here. We're quite nicely contained within tight ranges, and there's nothing on the data calendar, remember, and it really is all about Donald Trump's decision at 7 p.m. tonight, and then we kind of go from there. And also people are just hanging back, wanting to see what the US inflation data is, wanting to see what the Bank of England are going to do with rates on Thursday. These are the big events. Right, that's it from me. Enjoy the session. Thanks, guys.